Tim, good afternoon. How's it going?
It's going well, Aaron. How are you?
Oh, we picked a crazy time to do this, right before the deadline. We got like 2 weeks. So, you know,
Right.
I don't make great decisions 100% of the time, but we're here. Happy to chat. Excited to talk about accountable plans. But really, what are we talking about, Tim? Talking about how we can maximize those business use of personal assets and those personal expenses. I say personal because there is definitely some stuff that's personal, but I feel like a lot of taxpayers err on the side of saying, oh, well, that's not for business, so I'm not going to deduct it. When a lot of the times I feel like there's a lot people use a lot of those personal expenses and personal assets for their business and just aren't taking advantage of the tax code that's written there to incentivize them to run and operate their business and employ other people, create jobs, and add to the overall economy.
That's right. Yep. No, the biggest misconception is that there's loopholes. We hear that word a lot with our clients. What loopholes are available? We're not talking about loopholes. We are talking about IRS incentive plans. They want you to use these different types of deductions available to you legally to incentivize you to have more money to spend on your business rather than for taxes.
Yeah. No, I mean, there's a couple loopholes, right? I'm not going to talk about them publicly. I'm not putting that on the internet. Please don't take them away. That's why, that stays behind shut doors. But yeah, again, like accountable
Yeah.
plans, they're one of those things. They're there for a reason, and just know what people don't take advantage of them. To your point, the IRS made them to incentivize people, and people just don't use them. So yeah, let's get going with our material today. As we've discussed, we're going to be talking about accountable plans and how to turn personal assets into business deductions. Now, I feel like we should just start every presentation with this, Tim, but let's just talk about the most important section of the tax code, section 162A, ordinary and necessary. There shall be allowed as a deduction on all ordinary and necessary expenses paid or incurred during the taxable year in carrying on any trade or business. That is one of the most important lines in the tax code because it's the basis for everything else. Right?
That's right.
And the term ordinary and necessary, like all other IRS terminology, is vague. Whether that be intentional or unintentional, it is vague.
Right.
But that's what the other sections are there to help clarify. But the biggest misconception I hear is, well, ordinary. Again, is it normal in the course of your business? That one, I guess, maybe that one's not a misconception. That one is pretty cut and clear. That makes sense. But necessary.
Right.
Does it help or attempt to help the business? And a lot of people sit there and say, well, it's not necessary. Well, think about it like this. Is it necessary for us to have computers?
Absolutely.
Is it? Yeah. Well, I would say no, right? Necessary. We could do tax returns on paper, right?
Sure.
Do we need to be doing this webinar right now? Do we need to be educating our clients? No.
Right.
But it's in the operation of business, and it's in a way to help generate profit for us and help generate profit for our clients. So it is necessary in the fact that it operates in the way to help the business. Now, can you sit there and say, well, it's necessary that I go get a back rub at 12:30? Probably not, Could you argue that, hey, it helps me relax, it helps me be more productive? It's like, yeah, pushing it, but not
Right.
necessary. And so that's really the biggest thing is the basis for all tax deductions. Ordinary means, does it make sense? Does it make sense for me to buy 500,000 pounds of plastic? Absolutely not. Wouldn't be ordinary. Would it make sense for Nike? Probably. Makes sense. That seems ordinary. So really, that's just the key to everything is ordinary and necessary. Now, Tim, you're familiar with this game, so I want to play a little bit of this. Real or ridiculous? So these
I
are
like it.
all. Probably shouldn't have given the answers if we were going to make this a game, but you know that I'm going to take any opportunity I can to talk about SV Commissioner. Now, these are all great examples that Tim and I have found over the years of some things that you think would be ridiculous, some things that wouldn't be ordinary and necessary that were, and some stuff that was ridiculous. And they are all things that, hey, I thought that this would make sense. We could deduct this. You know, obviously my favorite, let's talk about the elephant in the room. SV Commission brought it up a couple times. There's breast implants for an exotic dancer. Her name was Chesty Love. I know that. It's ingrained in my memory.
Yeah,
That's how you get a group of college kids to pay attention in class, right?
that's right. That's
But
right.
legitimately, they talked about this. This is one where I would sit there and say, yeah, like obviously that's personal use, right? Like it's something that you purchased that's inside of you for like when you're sleeping and not working. How is that not
Hmm.
personal? But I believe their terminology was that it was quote unquote so freakishly unnatural that it could have only been for business. Um, and so really I like to use that one just to like push people's bounds of what they would expect. Because even me, I was like, that's pushing it. But the IRS
Right.
said, nope, 100%. This is
Yeah.
absolutely for business.
Yeah, because the main thing we want to do is outline how it is completely subjective what is ordinary and necessary. And if you are able to make substantiation for whatever you find to be ordinary and necessary for your business, let's talk about it. And so, yeah, it's a great way to introduce the topic because it's something that even as tax preparers, we sit here saying, no way. No way they got to deduct that. And yet the court backed it up and said, yes, this is deductible.
Yeah, we cut out there for a second, so I don't know if it was just me or everyone else. But what, which example were you using there?
Well, I was just saying that making it ordinary and necessary subjective to your business and
Yeah,
what it is that you offer is going to be different for other people that run different businesses in different lines of industries. To where ordinary and necessary for one business isn't going to necessarily be ordinary and necessary for another.
yeah.
But that's where we just want to open up your eyes to what the potential is and get you putting your subjective lens onto the situation so that we can then help you out in figuring out whether or not you can deduct those things and get creative.
Well, you just that line of what you just said it makes me want to talk about Jackson v. Commissioner, which the RV for the RV
Hmm.
insurance salesman. Because while you're saying everything's subjective, there's a few things I was like, let's not even push, which we'll get to later.
Correct.
But I think ordinary and necessary. An RV insurance salesman purchased an RV to attend RV conventions. I can't think of a way that you could make that more business use. And I don't remember the exact line, but I believe the judge asked him something along the lines of, "Well, did you use the restroom in the in the RV?" He's like, "Well, of course, in breaks." And they're like, "Well, what did you do when the convention was on break?" And he's like, "I mean, yeah, I watched the TV." And they're like, "Well, that's personal use." What? I
Right.
mean, insane. And that's where I say, man, if that guy can't deduct it, no way anyone else is. Don't even risk it. Not worth it. Not worth it.
And
I'll hit these other
RVs
ones real. Oh,
RVs
sorry.
are RVs are one of the most popular purchases, right? Everybody buys an RV and says, "Oh, I'll write it off through the business." We have a court case that shows you cannot do that. So
Yeah.
let's not push the boundaries there. There's plenty of other places that we can limit your tax liability legally.
Yeah. Absolutely. Well, I'll just hit these other ones real quick because we don't need to spend all day talking about
Sure.
feral cats and RVs. I like the cat food to attract feral cats to a junkyard. That's just a fun one. You know,
Yeah.
if you're a
Yeah.
cat enthusiast, make sure you just got some pests. It's, truthfully, it also lays the groundwork to, uh, farmers. It's almost necessary that you have a dog to protect, scare
Hmm.
away predators, invaders,
Security.
and it's I think one of the key things is this was attracting feral cats to cull the rat population, to quote the court case. But again, it does open that. open that door. The other one I thought was hilarious was that 6 month African hunting trip for a dairy farm, but they made a museum and made it a whole marketing thing. And I think the big takeaway there is, Tim, you and I are great at this. We love going on vacations to conferences, right? We just went to Tampa and I had a great time in Tampa. Now, we were at a conference the whole time. That doesn't mean we didn't hit up the beach after the conference. There
Hmm.
was hitting up lunch. We went, hit the pool. You can enjoy that time and still make it a business expense. There's no rule that says for it to be necessary, you can't enjoy what you're doing.
Right. Yep. And just to piggyback on the idea of having animals as security, one situation is if you've got a van with equipment. We had a client that has a dog at home, and there was a string of burglaries going on in the neighborhood. His dog alerted him that someone was in his van out front,
Yeah.
and he ran outside. The person ran away, but he was able to save a bunch of his tools and potentially his entire van because of his dog. A dog is a great, and so it's not just for junkyards. And this is where I say the subjective lens. If
Yep.
we can look at it and make it ordinary and necessary, let's deduct it.
Yeah. Absolutely. Yeah, let's hit these last two of ridiculous real quick. Landscaping for the home office. This one was really just saying the person's like, well, my house has to look nice because I bring clients to my home office. And it's like, you're only getting, they ended up allowing a portion of it, but it's like, yeah, you can't,
Right.
you know, um, sitting there and to say, uh, I wouldn't do my yard work if it were. Now, that could be true. I mean, that might be the case for me, but they're not going to let that fly. But we'll talk a little bit more about
No.
home offices later. We got a whole slide to that. And then the Rolex for the top salesman. This wasn't a court case, but this is something you and I have run into a couple times where it's people want to give extravagant gifts to their top performers. The problem with that is anything you give to an employee, it's going to be wages. So, I mean, the
Correct.
de minimis gift limit, the argument of if I take my employee out to the golf course for his birthday, the gift limit's 25. I would argue it's more of an office outing than a gift.
Correct.
So there's some nuance. Now we go and take him to a trip to Hawaii for that golf trip.
Right.
Probably not, right? That starts to become a gift. So anything that's gift is going to be compensation.
Yep. And so let's be clear. Put that on his W-2, and you're still deductible, but
Yeah.
he has to show it as income.
Oh, and you got to put it on the W-2 and pay payroll taxes.
Correct.
So you're paying. I mean, that's where you're going to deduct it, but you're going to be paying some. Tim, what do I got here?
Ooh, pigs get fed.
Hogs get slaughtered.
Mm.
It's my favorite saying. And what do we not want our clients to be? Don't be a hog.
Don't be
You
a
know,
hog.
be the pig. Take advantage of the tax code as it's written, but don't do things that are ridiculous. And I'm all for hey, if there's no court case saying yes or no, let's push the limit. Everyone likes to say there's the tax code's black and white, and I'm like it is intentionally subjective. And so when there's a black and white line, absolutely don't cross it. If there's some gray, I'm here to represent the taxpayer. I'm not here to represent the
Right.
IRS. And
Right.
again, their rationale is that it's more likely than not. So is there a 51% chance my stance is going to get upheld? If not, then I'm going to get penalized for being unreasonable, And that's where, again, don't be a hog. Don't do something stupid. But here's the list of things, golf club dues we talked about. A little bit different than green fees. I don't want to get into that nuanced conversation too in depth.
Correct.
But golf dues, memberships, country clubs, completely no, don't even try. I mean, Tim, I can't think of, even here's an example where for business use, you're a country club member, right?
Correct.
And you go there to take clients, you go to meet, they're not going to acknowledge that. And they've written that in the tax code. They've made that very clear. So we just don't deduct it. Do I disagree with it? Sure. I'm not here to fight the IRS, right?
Right. Right. Well, and just to be clear about that, you still can deduct anything that you have to pay outside of the membership dues. Um,
Correct.
so there is still some deductibility there, but yeah, it's this type of thing that we would love to deduct it. We think we should be able to. The court said no.
Yep.
So that's black and white.
Yep. Same with gym memberships. It's the same rationale. We talked about those RVs and the campers. Jewelry, that's a really hard one. It's maybe if you're a theater company and you're getting prop jewelry for a production or something,
Right.
sure. But again, most of the time we're talking small businesses. Getting your wife earrings, even if she's your top sales performer, not going to be able to call that a deduction.
Right.
Investments and investment assets. That's another one. I don't know if you get that a lot, but I hear a lot. Well, I put 50 grand into my buddy's business. How can I deduct that? Or I bought a bunch of stocks. So it's like, well, I don't actually have the cash that I made last year because I put it all in the stock market. It's like, well, those are all non-deductible expenses. So it's like, it's great that you have that money somewhere, but you're going to have to liquidate that to pay the tax bill. And I don't know where that comes from. That's a big misconception I hear all the time of, oh, well, I bought some stocks. Can't I write that off? It's like,
Right.
you can write it off against the sales price when you sell it.
Yep.
But not as a business.
Correct.
Haircuts, makeup, self-care, all that stuff. Again, it's going to be really hard to justify that. And that's where we say, hey, avoid these things. Clothing. Now, clothing's a really nuanced conversation because, Tim, obviously, we're both wearing our Valley polos with our logos embroidered on them, right?
Right.
You bet we deducted that. Now, I don't know if you weren't the one placing the order, so I don't know if you got to go through that whole fun step, but there's a bunch of regulations, a whole process from the IRS. Because if you buy a shirt and then get it embroidered, only the embroidery is deductible. If you buy a shirt, it's shipped directly to the embroiderer, and then the embroiderer embroiders it and then delivers it to you and charges you for the shirt as well. So there has to be, they purchase the shirt and then and reselling it to you. Then that's how you can get it to be fully deductible, because the argument is they've made a new product for you. But even if you buy the shirt, pay the vendor, ship it to the person, and then they embroider it, they're only going to let the embroidery. Now, obviously, we're talking about clothing that you're going to be wearing, right? Like if you're buying the shirts to hand out at a conference, you're going to be fine. You don't really need to worry about it. Again, it's if the employees and you or yourself are wearing it, they're going to see it more as a personal asset. And then rent and mortgage, we're going to be talking about that home office, but again, those aren't, you can't deduct the rent, you can't deduct the mortgage. There's provisions specifically for doing the home office, which we will get to next.
Yeah, and real quick about the haircuts and the clothing, the way the IRS looks at it is you are buying clothing regardless if you run a business or not. So if there's nothing distinguishable about it, that's where you say the embroidery is going to always be deductible because that distinguishes it as business. A haircut, even if you're a realtor and putting out all kinds of online content, it doesn't matter. You still have to get a haircut, regardless if you are a business owner or not. It's like the landscaping example you gave earlier about the home office.
Yeah.
These are common routine maintenance that you're going to have whether or not you run a business. So that's the way the IRS looks at it.
Yeah. Well, and piggybacking off the clothing, because you said a really important thing there, distinguish.
Right.
Well, to clarify, for distinguish, it distinguishing doesn't necessarily mean like, well, I'm an attorney, so I'm wearing a suit. It's like, no, they're still not going to allow that because you're just looking professional, looking good. It might be completely necessary for you to look good. And I think that's even a thing with salespeople. It's like, look good, perform well, right? People expect to see a salesman driving a nice car and wearing a nice suit and clothes. Just because it's expected societally does not mean it's necessary from an IRS standpoint. And that's where the embroidery comes in. But, all right. So we've talked a lot about just what we can deduct and what not. So what is an accountable plan and why do we care about it? And the thing about the accountable plan, the entire basis is ordinary and necessary. So an accountable plan is just a way for business to reimburse employees for business expenses that they've already expensed, right? And probably most people are doing this and they're probably not doing it properly. there's a lot of it that goes on. Be above board with it. There's some quick, easy ways to make sure you're above board with everyone. And then there's some ways that if you're the owner, you can reimburse yourself because as an owner, you're an employee. You just happen to also own the company that employs you. And if you're doing those, you need to be very careful and you need to be very deliberate with those tactics.
Yeah, and this can be a great way to reimburse your employees for expenses that they've already incurred, like you said, and give them a little bit back while you get a deduction.
Yeah.
And they don't have to recognize it as income. It's a
Well,
great. I don't want to jump ahead, but it's really a powerful strategy.
Well, and to your point, like it's a great fringe benefit of like, hey, we're not. This
Right.
isn't a compensation thing, but we're gonna make it competitive. I think the perfect example is, accountants. It's very normal for me to get reimbursed for my tests and my classes as I get a CPA endorsement. I mean, that is me developing myself professionally. The license was under my name, but when we were working for someone else, of course they're going to reimburse that because it helps the business if I'm a CPA. So things like that, you can find some stuff for your employees. Now, I am sure the number one thing that people here care about is how can we reimburse the officers, right? How can you get some tax-free
Oh yeah.
compensation to yourself? And I do want to break into that real quick. I do want to say, if you've got any questions, I forgot to mention this at the top of the show. Comment your questions below or email us at info@valleytaxes. We are going to have an open Q&A at the end, so we will answer any questions that we see come through. Again, we'll try to answer. If something comes up that's relevant, we'll answer it during the show. Otherwise, we'll take them at the end. I'm actually just going to leave that up there. Comment your questions. So, accountable plan, ordinary, necessary. It must be written. That is something that I think 95% of people, because I'm pretty sure everyone's reimbursed their employee at some point, right? I
Right.
bet 95% of small businesses don't have a policy written. We didn't have a policy written when we first got an employee. And that's, I don't want to confess to that on the internet. It's something you put to the back of your mind. I mean, we had one.
Yeah.
I meant to say we had one and I just didn't know where it was. But it's important to put these things in writing because you don't want to wait until you get audited to then be able to oh, well, let me put that together. And well, you didn't have it in writing, so we're not going to allow it. The employee must provide receipts or documentation. So it can't be the type of thing of, hey, I spent $5 today, give me $5. If they have to give you the receipt, they got to give you the documentation. And then again, with the vagueness, the IRS says the payment must be made within a reasonable period of time. What's reasonable, right?
Right.
Now, they did provide some safe harbor timeframes, which I find funny that they're they do this a lot, right? They leave things vague, and then they say, well, we're not going to say these are the rules, but we'll tell you if you follow these rules, we're not going to punish you. And it's well, if I don't follow the rules, are you going to punish me? Well, we won't punish you if you follow
Yeah.
them.
And if they never come knocking, and never ask the question, then you're safe.
Yeah. But again, they don't define a reasonable period of time. There's a little bit is weird on the treatments because they say you can give an advance payment, right? So it's the employee, hey, I got to travel, I traveled coming up, and you can say, okay, well, I'm just going to give you $1,500, and then we'll worry about it later. Because again, that statement is you have to provide documentation. So their deadline is they're saying within 60 days give substantiation for that deduction. So what they want to see is if you're going to give an advance payment, do it within 30 days. If you're going to do a direct reimbursement, then you do it within 60. And then if you over reimburse, then you need to settle it within 120 days. That's their statement, right? These are the safe harbors. Again, I don't think of many accountable plans that have advance payments. Most of them that I see are reimbursements, right?
Correct.
Because
Yeah.
if you're going to do it, why reconcile it? Why worry about it? Just do it right the first time.
Right.
So, biggest one for officers is home office. And this is one that I don't see. I mean, everyone should be doing it. It's hard to think in this day and age that not everyone has a home office, right?
Right.
I mean, you've got an area at home. I've gotten an area at home. You've never taken a call at home. You're working
Right.
at home. So and this is where it becomes finding a way to make it ordinary and necessary, right? Follow the rules
Yes.
so that we can deduct it. So the IRS says area must be used exclusively for business. So, ideally what the IRS wants is they can come into your office, put blue tape around an area and say this square footage is only used for business. And you don't even, think about stepping in it for personal time. Now, don't use a hallway, right? Because you're always going to be walking through it. But, it doesn't need to be its separate room, right? My bedroom, I've got a corner of it sequestered where it's just my office, right? It's
Yep.
just that section. Like your garage is where yours
My
is.
garage.
You know,
Yep.
it would be, you don't need to build walls around that space, but it needs to be exclusively for business within, again, within reason. If something falls into the square, it's not made of lava, you're allowed to, reach in and mess with it. But again, they want it exclusive business use. And that percentage is really important because that's how you're going to do all of the other expenses that are based on percentage. So
Hmm.
utilities, interest, taxes. We'll talk about Schedule E versus a self rental. So you take a percent of those electricity, gas, water, stuff like that. Now, I posit there are some business expenses, right?
Yes.
Your cell phone, I say, sure, everyone's going to use their business phone for work, or sorry, their business phone for personal use at some point, right?
Sure.
Go show me a government employee that doesn't have a Facebook page on their
Right.
phone. Um, but the reality is, and what I differentiate from these from utilities is like electricity. It's like, yeah, sure, your business needs electricity at home, but the more electricity you use, the more you're going to be charged. So it's easy to make sense to do a percentage split. That cell phone, you could have two lines. You could have a business and a personal line. And guess what? The business is going to be deducting the same amount either way. So I don't really see that it's reasonable to reduce your deduction for 100% business expense that is necessary for your business. It's ordinary for your business. It's a requirement in these day and age. And almost all day you're using it for business. And then, yeah, sure, maybe you're playing some games on it. Maybe you're taking a personal call. My dad, he works for a company that I won't name. They pay for his phone, they deduct it. You think I haven't texted my dad during the workday,
Right.
or I mean after hours? Let's say after hours. You know,
Yep. Yeah.
everyone's using it to a certain extent. So if a big business can do it, so can you as a small business. And I say the same thing with internet. Now it's different if either of those are based on how much you use. Most of them are pretty flat rate, unlimited. I actually have a business internet plan to Valley CFO at my home. Um, I hook up a couple things to that Wi-Fi, but I could get a completely separate Wi-Fi network, and the business is not going to be paying any less.
Right. Right.
So
And I think it's important to note we are advocates for the taxpayer, not for the IRS. So this is our opinion based on how we think about the tax code. We know of other tax preparers that disagree with what you just said about cell phones.
yeah.
But my argument is a PC is going to be the same thing. Are you telling me that you're not looking up fantasy football on your PC, on your work PC? So it's the type of thing that your work PC is going to be used for both business and personal, but it is absolutely necessary in your line of work, and you need to have it. You need to have it to be able to provide all the services that you're offering. So our opinion is we want you to be deducting it 100%.
Well, and I look at it from the incremental standpoint, right? Like if you use it personally, does the expense go up? If it doesn't, then it's just a de minimis fringe benefit, right?
Right.
Again, this is all within
Exactly.
reason. I'm trying to think of a good example of where it wouldn't be, but I think we're being pretty reasonable with these. It makes me think of the argument of, hey, Tim, you and I fly to, I don't know, maybe Indianapolis coming up.
Sounds about right.
Sounds about right. Maybe we tack on a few extra days as a vacation, right?
Hmm.
I've had tax preparers say, well, I'm going to take personal days, business days, every expense on the vacation, divide by that percent. Okay. The flight there and back is the same. Sometimes I've had the flight be less if we say a couple extra days. So you're telling me that the business not only doesn't get to deduct the flight back because I used some personal days, but actually I saved the business money. So they're getting less of a deduction anyway. So you want me to buy a flight back specific? No, doesn't make sense. I'm not going to back out the flight. Now, the personal use hotel days, don't write those off, right? Write off the
Right.
ones for business. Now, I'd take it a step further and just make sure you don't have personal use days on those hotels, right?
Correct.
But
Correct. Yep.
if you're going to do
Whole
that,
nother conversation there, by the way. Whole nother conversation. But yes, don't take personal days when you take a business trip.
yeah.
Make it a
Or
business
over the
day.
limit, right? They allow you a certain amount of hours and days.
Correct.
Keep it under the ratio, which we won't get. Whoops. We're running out of time, so I'm going to cruise these through these a little bit quicker. This was really a strategy that got big during COVID, and I am a much bigger fan of doing an accountable plan for your home office than a self rental,
Hmm.
because one, it makes it a little bit more standard for if you rent or if you own, versus a self rental is the homeowner only, and you're
Sure.
kind of just out of luck if you have a rental, um, or so yeah, if you rent. The way the self rentals work though is you're actually making a Schedule E self rental, so you're reporting rent income and then rent expenses. And the business now, the safe harbor you have is the IRS. It needs to be fair market value, but you can get, there's no rule on what you can pay yourself rent, right? They're not really getting in the nitty gritty because it really doesn't matter, because it's like, okay, well, I'm deducting this here and paying income tax on it here. Either way,
Right.
it doesn't matter if you increase or decrease the rent you pay. What matters is those expenses that you deduct. The thing about it is you do get the benefit in the now of, you also get to depreciate the value of the home. I don't like that, because then when you sell your house, you have to do the depreciation recapture, and now you're paying more of a gain when you get out of that property. That's why I don't like to do the self rental. It's also more complicated and it's more paperwork. Um,
Right.
and it's messier. I like the accountable plan, because under the accountable plan, again, it's ordinary and necessary. So interest, taxes, utilities, you're going to take a percentage of those deductions. And
Hmm.
the biggest benefit is when you sell your home, you don't have the depreciation recapture. And it's really, again, the depreciation is great now, but when your house is an appreciating asset, at the end of it, you're going to have to pay. So I've had those people that use their home office and they're like, well, what about that $500,000 exclusion of gain? And I'm like, it doesn't matter, because that doesn't exclude depreciation recapture, only capital gain. So no matter what, you're paying that. You're saving money now to pay it back later. And we're not talking about a material amount now, but over 10, 20 years, that can
Right.
add up to taking a big chunk out of your house when you sell it.
Yep, and if you have questions about that, see our cash flow video, because that's exactly what we went into. When you're taking a deduction now, you don't have it for later. And I also want to make sure that we know this is really for S corps. Schedule C, you're going to take the simplified home office deduction,
Oh yeah.
and that's that. But
Partnerships
this is,
also.
yep, yep. So, but that being said, you're talking about taking something like property taxes. You're not getting to deduct that through your business, unless you work up an accountable plan and reimburse yourself for rent. Now you're all of a sudden you're taking that Schedule A deduction and moving it into your business.
Absolutely. Yeah, I drew up a quick little example, um, of just what the accountable plan for a renter versus a homeowner. As you can see, sorry, I'm getting over a cold. The
Yep.
renters, it's a lot more straightforward, right? You take a percentage of your rent. Homeowners, it gets a little bit more complicated. You got that stuff that you get to the personal return. Um, but again, this is, a 2,000 square foot house. I mean, and I took pretty average. We're not talking about small change here. This is a pretty sizable deduction. And this is, again,
Yeah.
this is where it's different from a Schedule E. This isn't something that you're going to be, oh, well, I'm going to, charge rent to the business and then call it income and then write off some of that income. This is a straight deduction that you're going to be getting directly to your business by doing an accountable plan with your home office. And then lastly, there's a lot to be talked about videos. There's a whole other video to talk about for auto. I want to keep it
Oh
brief,
yeah.
on what you can do with an accountable plan. But the biggest thing that is important about having a home office is maximizing your auto expense, right? This is a tactic that Tim and I didn't come up with, but we went to, these are why we go to these seminars where they teach, hey, this is the tactic. This is a classic tactic that we've learned in a seminar for years. If you have a business vehicle, you only get to deduct the business mileage. So anytime you're commuting, that's not deductible, right? So you're driving from home, you're driving to your office,
Right.
that's not deductible. Well, that's almost 100% of my driving. But
Hmm.
if you have a home office, are you ever driving from home?
Oh, yeah.
Well, no, right? You're driving from your home
Oh,
office.
correct. Yeah.
So now all of a sudden you're traveling from business location to business location. That's not commuting, that's
Right.
business. So that's the importance of having a home office, is it helps justify the rest of your auto expense. Um, and it makes it a lot more clean cut. With the
Yep.
accountable plan, it works for mileage and it works for leases. It's not, if you're financing a vehicle, don't use an accountable plan. Have the business buy it or just reimburse yourself the mileage. Um, that's the easiest way. The lease is also, again, pretty straightforward. You just deduct as long as you have a operating lease. You know.
Yeah. Yeah, and this is the one that we utilize with my business vehicle, because I have my home office. It's anytime I'm going from one business location to another, I'm tracking my business mileage, and then at the end of the month, I reimburse myself from the business for the business use of my vehicle. And we do that once a month. It's a written plan that we have in place, and it's a great way as business partners, but you and I, Aaron, it's always a great opportunity to take advantage of when you can get some sort of reimbursement from the business outside of distributions and W-2 payroll. It's a way to be able to kick back to us as business owners for personal use of vehicle, home office, all these different things. It's a great way to get access to some of that business cash that's otherwise taxed.
Yep, for sure. Yeah, anytime you can get tax-free compensation, why wouldn't you
Yeah,
take?
right.
Um, the the big thing I want to talk about, I forgot to mention this earlier. The home office is a great way, right? I laid out that example to turn your auto into 100% business. The
Right.
one that I've heard a lot, everyone's like, well, I put my company logo on my car. So it's advertising. Anytime I'm driving around, it's advertising. And that's been shot down pretty easily.
Right.
Because it seems too easy, You talk, I'm like, yeah, I have my our company's names on my license plate, and that's just an
Right.
ego thing. That's not even an advertising. That's definitely personal. Um, but it's again, it's one of those things where it's like we hear these strategies, and it's like there's ways to do that strategy, just do it correctly, and that's where I say, yeah, putting a logo on the vehicle does not qualify as 100% business use all the time. There's way easier ways to do it. Now, that said, most of the time I think about it, it's like you see a big van with someone's logo on it. Probably a bit, employees are probably driving it. But again, it's more of those personal ones that people are, well, I'll just coat my car. It's like, well, if it's an eyesore, paint it the color you want it, keep it, and just follow the right rules.
Yeah, and it's back to the clothing example. It's like an embroidery, right? So you can still deduct the wrap.
Oh,
Let's
exactly.
let's not get that twisted. It just doesn't turn your vehicle into 100% business use like people are implying. Mary Kay is a great example, right?
Yeah.
It can be good advertising, good marketing. We're not discrediting that. All we're all we're saying is that the tax law does not allow for that to just automatically make it 100% business use. Having a home office that you're leaving to go to another business location, now we're starting to talk about making your personal vehicle 100% business use.
Yeah. We went a little over today, but I think we had a good conversation. I'm looking through. I see that Eric is taking some good notes, and I appreciate the feedback. Glad you're.
We lost Aaron. Aaron, we lost you for a
Oh
second.
man, dude, we got to fix the internet at this office. Which, hey, I just want to say, we're talking about home office. We're talking about accountable plan. We wouldn't have this internet plan at my house. My house's internet never cuts out like this. You telling me that's not? Come on, come on.
Yeah, yeah, yeah.
Definitely some business, primarily for business there. But sorry, I was saying, let's wait a couple minutes, see if we get any questions come through. Do you have any final thoughts you wanted to wrap up, Tim?
Well, this is a great that we would like to cover topics that give a good objective view of how we look at taxes and what is a deduction. I mean, this dives right into the heart of our overall theory on deducting what we can. The way we always frame it to our clients is, what are you spending your money on already that we can justify use for business? And so this is one of the biggest avenues that we take, our accountable plans, so that you can reimburse yourself personally from your business. Because remember, your business and you are two separate entities. And we want to make sure that you're getting the most benefit and value personally from that entity. And accountable plans. So really, if you have any questions or maybe ideas, please reach out. We love to dive into different ways that we can get you some of those fringe benefits, especially as a business owner, and to be able to offer those to your employees as well. I mean, we didn't even dive into for us personally, if we hire someone without an education in accounting and they decide that they want to become an accountant, say like an administrative role or something of that nature, there are ways that we can do an accountable plan to reimburse for those expenses that they incur getting that education.
Certainly. Yeah. Yeah, I think the best thing that I heard was the tax code was designed to incentivize business and business growth. So a lot of
Right.
people will frame it as like, well, these businesses are blah 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 taking advantage of. No, it's how it was written. You're using it how it's meant to be written, and take full advantage of it. And I think there's just a lot of people that get caught up on the details of it that just don't. They want it. Well, I don't want to have to worry about the rule. I mean, let us worry about the rules and regulations. But I
Right.
think even there's some accountants that are, the juice isn't worth the squeeze. I,
Oh,
you know, hard to find a time, especially let's look at that home office. 16 grand. That's a pretty juicy squeeze there.
that is a lot of juice in that squeeze.
Certainly. All right. Well, we don't have any questions coming in, so I think this is a good time to end it. And we will see everyone next month, October 29th. Surprise topic. If you have a topic that you would like to chat about, please feel free. Shoot us an email. We take feedback. We'll look at the comments. Happy to, there's something that's just itching that you need to know. Give us a topic. Don't make us come up with one. Save us some work. Until next time, we'll see you then.